Hello and welcome to this educational video brought to you by SensaMarket. My name is Matt Williamson and today we are going to be talking about zero DTE options. What is DTE? Well, that's days to expiration. So a zero DTE option would be one that expires today. 0 days to expiration equals today. All right, these have come into prominence crazy big crazy as of the last year or so. And there is just so much volume on these things that we really need to make sure we know about them. Okay, so let's talk quickly about how they came to be before we dive into what people are doing with them. Okay, once upon a time, the CBOE, which is the Chicago Board Options Exchange, did their thing with normal options on the S&P. Okay, normal options expire on the third Friday of the month, and so we had S&P options that expired on the third Friday of the month. Now, those options were a little funky. This is a little background now, it's not super important, but they actually stopped trading on Thursday afternoon, and then they got their final value on Friday morning with something called the set price. Anyway, so they technically expired Friday afternoon on the third Friday of each month, and people traded them a lot. They were S&P options. People needed those things to hedge and or speculate. But at some point, the CBOE looked at the volume and they said, you know what? We could probably make more money because people are trading these things a lot. Let's see what happens if we roll out weekly options instead of just monthly options. Let's see if people buy them if we have them every week. And so they did. They rolled out weekly options, and they were so absolutely ridiculously popular. They were doing so much volume, it was insane. So the CBOE looked and they said, you know what? Let's see if we can catch lightning in the bottle twice. Let's try 3 days a week. Let's have a Monday option and a Wednesday option and a Friday option. And wouldn't you know it, those did crazy volume as well. So then CBOE put their heads together and they came up with a great idea. They did it just like Gillette. They said, you know what, let's just shove one more razor in there. And the CBOE said, hey, you know what we're going to do? We're going to have options that expire every single day. So now there are Monday, Tuesday, Wednesday, Thursday, Friday options every single week, and they do tremendously huge volume, just absolutely massively huge volume. And mark my words, there will soon be a noon expiration. There will be a morning expiration. There will be an afternoon expiration, and there will be a lunchtime expiration. Because why not keep milking that cow? All right, so these things do huge volume. We're going to go over to the options chain here in the SensaMarket platform. And this is the spiders, the SPY. You also have the SPX. Both of these are the S&P 500. The SPY is the ETF, and the SPX is the index. But both have options and both do tremendous volume. So if we look over here, just at the volume, we are talking about, this is actually out in April. So let's go to today. Today's March the 2nd. Sorry, March the 3rd. Today's March the 3rd. So you can see volume 60,000 contracts, 42,000 contracts, 114,000 contracts, 243,000 contracts. That's just on the call side. Just on the call side. You look at the put side, we're talking another 100. I mean, the size here is absolutely colossal. Okay, and then we can go tomorrow. We have 1 day to expiration. We're still looking at, 21,000, 20,000. This is just volume for the day. Okay, we can compare it and go out to, let's say, let's go out to like the April monthly. So these would be kind of the normal contracts. Okay, 1,600, 1,000, 1,800. These are like respectable contract numbers. But if you compare it to the contract size today, it's absurd. You're talking 800 contracts versus, 172,000 contracts. All of the volume is concentrated in these front 1 day, 2 day, 3 day options. So, it begs the question, like, why? What's going on here? What's happening here? And the short answer is, there's a lot of speculation happening, a lot of same-day hedging happen. It's just a big casino at this point. You can buy an option for the spiders, okay, for the S&P 500. Let's just look at tomorrow's pricing here. So tomorrow's pricing, $3 option on the S&P. Okay, $3 option for 50 delta. 45 delta, sorry. It's close. 45 delta, that means you can basically get a 45 share position, a position that's going to behave like 45 shares of the spiders, and you can pay $304. Okay, we're just going to do some quick math here. $304 times 45 shares. I'm sorry, $304 is 45 shares of a product that is $583. So if we do our $583 times 45 shares, that's basically a $26,000 position that can be had for $300. Okay, so we're talking about the 585 calls here. We can buy them for $3. It's a 45 delta, which means it's basically going to behave like 45 shares of this, which is a $26,000 position. But we can get into that position for $300. So if we do a little quick division here, $304. Let's be accurate. We can get 86x leverage on our position in a day. 86 times leverage. Okay, the speculators just drooled all over their keyboards. 86x leverage one day in the S&P. Okay, and just to put it in perspective, the spiders moved $10 today. Okay, it was a little bit of a shellacking to the downside, but the spiders moved $10 today. Okay, all this has to do is move up 3 for you to break even. Plenty of volatility. Okay, if this makes a recovery overnight, we could go from 583 to 589, 590. Not a big journey up there. If we make it to 590, this 585 is already 5 points in the money. This thing's already worth $5. You made significant profit. So the speculatory, I don't know if that's a word, the speculatory value is massive here. 86x leverage. Okay, and there's also spreads to be found. We could use vertical spreads. We could use diagonal spreads, calendar spreads. You can trade straddles with them, all kinds of stuff, all those usual options strategies. And if you check it out, Sensa's got all of them for you, baby. All those can be traded 0 DTE. Okay, if you want to go trade a time spread, you could go 0 and 2, 1 and 3. You can mix and match all those different things. So the amount of things you can do is now super crazy, and you got more expirations with which to do them. It's one of the reasons I like options so much, is they're so versatile. You can do really anything with them. You can construct whatever kind of risk profile you want with whatever prices you want, whatever time frame you want. You can just about work up any possible combination of risk factors you want. So now you just have even more of them to work with. In fact, just today, the last 2 minutes of trade today, I sold a 0 DTE vertical spread. 2 minutes. Okay, 2 minutes to go. I could just sell one that expires today. Usually we couldn't do that before until Friday. We could do it at Friday's close. And then now we can do it at Monday, Wednesday, Friday's close. And now we can do it every day if we want. So there are trade plans that basically just look at every single day's price action and we'll take an option trade off of it into the close. And it's just something we couldn't do before. So super cool. I will say the thing you have to be really careful about is risk management. Okay, and risk management to me means 2 things. It's position sizing and it's making sure you have some edge. Okay, position sizing basically means don't go in with too large of a trade. Okay, there are people that would normally buy the spiders at 583 that will just opt to buy the call instead. But if you buy the call, instead of buying the shares, you can buy like 86 times the position that you want to get into. So don't do that. All right, that's a really bad idea. It's a very bad idea. Okay, so make sure you're exercising good judgment with regard to the position size that you're working with, and then make sure you have stops and targets if you're not going to just let the whole thing be your risk. So you could go into this trade, for example, spend the $300 and say, you know what, I'm going to hang on to this option for $300, hell or high water. I'm just going to let it go. And that's fine. That's risk management. You can let that totally be your stop. Okay, or you can go in and say, hey, I'm going to trade this thing, and if it doubles, I'm going to take it off. If it halves, I'm going to take it off. That way you're risking, we'll call it 50% to make 200 or to make 100%. So that's also risk management. So make sure you go in with a plan, whatever that plan is, and make sure you keep your position size appropriate and responsible. Okay, that's going to do it for our little educational video here on 0 DTE options. So if you're an options trader and you're interested in trading more frequently, this could be a very good vehicle if you've not already explored it. All right, take care, everyone. We'll catch you next time. Bye-bye.